Come discuss about how stock splits can boost the stock market. A stock split is like cutting a pizza into more slices. You end up with more slices, but it's still the same pizza. Similarly, a company increases the number of its shares, but the overall value remains the same. For example, in a 2-for-1 stock split, each shareholder receives an additional share for every share they own, having the price of each share. If you owned one share worth $200, after the split, you'd own two shares worth $100 each. So, why do companies do this? One reason is to make their stock more affordable to a broader range of investors. A lower price per share can attract more investors, increasing demand and often driving up the stock price. Stock splits can also signal that a company is confident about its future growth. This positive sentiment can lead to increased buying, pushing the stock price higher. Let's look at some real-world examples. When Apple announced a 4-for-1 stock split in 2020, its stock surged by nearly 30% in the following month. Tesla's 5-for-1 split announcement in the same year led to a 70% increase in its stock price. But why do stock splits seem to pump the market? One theory is the wealth effect. When investors see the value of their holdings increase due to a stock split, they feel wealthier and more confident, leading to more investment and spending in the market. However, it's essential to approach stock splits with a critical eye. While they can boost stock prices in the short term, they don't change the fundamental value of the company. Long-term investors should focus on a company's financial health and growth potential rather than getting caught up in the hype of a stock split. In conclusion, while stock splits can secretly pump the stock market by attracting more investors and boosting confidence, they are not a magic bullet for long-term success. Always do your research and invest wisely. Thanks for watching, and we'll see you in the next video.